gold is in a mini squeeze. How do we know this? Because open interest has fallen by about 43,000 contracts since the price low of 25.44 on November 5th, was it? November somethingeth. And we've had a $134 rise since then. So contracts are closing, price is rising, which means that shorts are closing at a loss. This isn't a major gold squeeze, but it is a squeeze, which suggests to me that the bottom for now is in an intermediate bottom in gold, and it will keep going. Gold has sliced back above the 50-day moving average without even a shred of resistance at that line. We're back near 2,700. That's another piece of evidence that the bottom is in. But yes, the big news this week is Bitcoin, which has tagged its all-time high in gold terms at 37.2 ounces, just below its all-time high, I think about 37.4, but we're just about there, which means if this high is not broken through, we have a potential triple top in Bitcoin. Has Bitcoin surprised me to the upside? Of course it has.
In today's news recap, silver outshines gold with over 20% returns in 6 months. What is propelling it? Silver has given an impressive return of 20.25% in the past 6 months, compared with gold's return of 10.29%. Silver sales witnessed a sharp spike in the recent weeks, especially ahead of Dhanteras this year. Investors not only bought it in physical form, but also in the form of exchange-traded funds. Silver has given an impressive return of 20.25% in the past 6 months, compared with gold's return of 10.29%. Rating agency in its report said the total number of folios under silver ETFs increased by nearly 215% to touch 4.47 lakh in October 2024, up from 1.42 lakh in the same period last year. Net inflows grew by 24% at 643.1 rupees in October 2024, as against 518 rupees last year. Silver ETFs registered an unprecedented surge, with the assets under management growing by over fourfold to touch 12,331 crore rupees in October 2024, up from 2,844.76 crore rupees in October 2023, it added. While gold ETFs have been in the market for quite some time now, silver ETFs were launched as recently as 2022. Ashwini Kumar, Senior Vice President and Head Market Data at ICRA Analytics, said the number of silver ETFs, which stood at 8 in April 2023, has increased to 12 in August 2024. If domestic inflationary pressures and geopolitical instability continue to persist, then silver may continue to witness upbeat demand. The market may see the launch of more silver ETFs in the coming months as its role in investor portfolio diversification, investment, and management becomes more crucial. Silver prices are expected to remain attractive, as the expectation is that the U.S. Federal Reserve will continue to cut interest rates in the coming months, giving a boost to silver prices. Besides, geopolitical tensions may prompt risk-averse investors to invest in safe haven assets like silver. Demand for silver is expected to remain upbeat due to its usage in electronics and green technologies. Moreover, investors often prefer investment in silver for portfolio diversification, and it is often seen as a hedge against inflation. This apart, cut in customs duty and change in taxation structure has made silver investment more attractive, Kumar said. Now, before we dive back into the best clips, I've got a deal you cannot afford to ignore. Black Friday's here, and so is your chance to lock in ultimate online security with NordVPN. Listen up. This is especially for you stackers out there. Keep your data safe, stay anonymous, and grab this exclusive offer. 3 extra months free, plus a 30-day money-back guarantee. Check the link in the pinned comment. Don't miss out.
Chart this week. I'm going to show you this chart in interactive in a second so you can get a better idea of what I'm talking about here. The black line is where we are in QT weekly. Right, you see here is the latest reading. I think it's $43 billion down on the balance sheet. What is notable about this, first of all, is that we are at a rate here that we haven't seen since before they started slowing down QT in June. The Fed slowed down its pace of QT in June, but we're beyond that now. We're at 43 billion this week. And it really hasn't been higher than 43 billion in any consistent way since QT started way back in 2021. This starts from the regional bailout, this chart here. We're going to go to an interactive chart right now, and I'll show you why I think this is pretty notable. You may recognize this chart from the one you just saw. So what I'm pointing out here is that QT, right, every time it's below zero, we have the balance sheet shrinking. A very rare circumstances, it's above zero for some accounting reasons or whatever. But generally, QT has continued since the regional bank bailout in March 2023 pretty consistently. We have here, this is the key. On October 9th, 2024, the balance sheet shrunk by 85 billion, and the next week by 7.556 billion, and then 9.876 billion, then 16 billion, then 19 billion, then 27 billion, and now this week 43 billion. So this is the first, second, third, fourth, fifth, sixth week of QT acceleration. Now, it's not just the Bank Term Funding Program that is causing this. The Bank Term Funding Program is being liquidated because rates are being cut, and the rate of the Bank Term Funding Program, which is the regional bank bailout program, those rates are steady, and as rates get cut, the rates of holding those loans to maturity become more expensive than refinancing those loans at lower interest rates, which the Fed is offering now because they've cut interest rates. So that is being liquidated, but that's not the only thing going on here. There's a whole bunch of other accounting things going on at the Fed's balance sheet that even I don't understand. But what is happening here is that the quantitative tightening program is accelerating for 6 straight weeks. And the faster we go down, the faster the reverse repos will eventually fall to zero, and the faster we will get to the final banking crisis, which is still just around the corner. It's a very long and annoying corner, but it's still there. Anyway, we're going to continue with the slides here. The next one shows you the monthly rate of QT, how fast indeed we have accelerated. The black line is the rate, the monthly rate of QT that we're at now. Everything above that rate is slower than the rate we're at now, and everything below it is faster. So we're about the average of the monthly QT rate that we've been in since the regional bank bailout over here. That's where I started the chart, has re-accelerated to the average level that it's been at since the regional bank bailout took place. There's a little gold squeeze going on, a mini gold squeeze. How do we know this? Well, if you look at the open interest chart here, you will see that the green lines on the bottom have descended to, right now it's 498,000. This is 1 day delayed. It says 501 here. We're at 498. So we broke 500,000. And during that time, as this has been descending, it descended from about 545,000 to now 498,000, something like that. But I calculated it's 43,000 contracts. And in that time, the gold price has risen by $134, which means that short positions, the ones who hold the gold short positions on the futures markets, are closing their positions, and because of that, the price is rising. So these bullion banks are closing their positions into a rising price, which means they are losing money on them. Not that much money. They're not in desperate, dire straits or anything, but this is very indicative of a firm intermediate bottom here in gold. I don't think we're going to go much below that, barring the next financial crisis, which might very temporarily, ephemerally bring us below this. And that will be our final opportunity to get some real money before we have a hyperinflationary explosion. So even a mini short squeeze is encouraging in the gold price, and it looks like we're headed higher, back higher from here, and very soon we'll be back to old highs and past them.
In today's news recap, India's gold market update. Festive buying holds ground in the face of high prices. Gold extended its record-breaking streak into October. Momentum softens post-U.S. elections. Gold continued its rally in October for the 4th consecutive month, hitting multiple fresh highs and closing the month with a gain of almost 5% at $2,779 per ounce. The price rise was driven by event risk and uncertainty surrounding the U.S. elections, along with escalating geopolitical tensions, which outweighed the higher opportunity cost for gold on account of a stronger U.S. dollar and higher bond yields. The rally in gold paused post the U.S. election as the dollar strengthened and Treasury yields rose. In fact, both international and domestic gold prices have fallen by 8% since the end of October. Despite this recent pullback, gold remains one of the best performing assets this year, with a YTD return of 17% in Indian rupee terms at the time of publication. Gold in the domestic market has been trading at a slight discount to its international counterpart since mid-August, reflecting a balanced demand-supply dynamic. Following the sharp import duty cut in July, the flow of smuggled gold into the country has almost ceased, making way for official imports. Despite record high prices, consumer buying during Diwali was strong in both gold jewelry and bars and coins. Markets and media reported higher footfall at jewelry stores and robust buying of coins via online as well as offline platforms. Promotional events and marketing campaigns undertaken by jewelers to lift sales. Indian gold ETFs continued to attract strong inflows in October, fueled by a favorable gold price momentum and increased volatility in domestic stock markets. The long-term capital gains treatment for gold, which was announced in July, has provided a continued boost, as reflected in the significant rise in inflows since that time. Now, we'll show you more clips, but first, check out our exclusive Black Friday VPN deal. VPNs are an essential way to keep your data private and secure, and with this massive discount, it'll cost just a few bucks. It's a no-brainer. Plus, you'll get 3 extra months free and a 30-day money-back guarantee. Check the link in the pinned comment. Don't miss it.
First repos, despite all this encouraging talk, have stubbornly persisted at just below $200 billion for this whole month. We're at $188 billion. We've got to issue more Treasury bills to get these back down to zero. Hopefully that will happen before the end of the year, and then we can get into the final banking crisis, hopefully before Trump takes office, maybe a little bit after. It's not going to be that far into his term if it happens after he's inaugurated. Don't worry. These things are pretty frustrating right now because they're just flirting with zero, and they will get there. We just all have to be a little bit more patient. Gold slices back above the 50-day moving average. This chart is a little bit out of date. It's 1 day delayed. We're at 2690, well, maybe 2700 right now, depending on when you're watching this. I think we're going to break 2700 pretty fast. And the blue line, the 50-day moving average, is at 2675. So if we break through that and we hold there, that would mean that the 50-day moving average did not serve as any kind of resistance. Which means another sign that we've hit a firm bottom at about 2540 something or wherever it was down here, and we're not going to look back. But yes, the big news this week has been Bitcoin. We're nearing $100,000 on Bitcoin, and in terms of its real price, in terms of ounces of gold, we're at 37.2, I believe, and the high in October 2021, I think it was 37.3 something, so we're very close. We can count it as a tag of that top in Bitcoin. Did I think we were going to get here? No, I didn't. And so if we hold this triple top here, you can count one tag over here in April 2021, another tag over here in October 2021, and finally the third tag over here. If there is a triple tops are vicious, bearish patterns. I don't know if this one's going to hold. We'll see. But if Bitcoin is going to break through, it's got to break through quickly, or there will be a triple top. And watch out for that, because I don't think Bitcoin is going to deal with the next financial crisis very well. I think it's going to deal with it worse than it dealt in 2022, and it's going to hurt a lot of people, and it's not going to be pretty, I'm afraid. Japanese yields are about to break through a 25-year resistance at 1.08. Go to a 25-year chart, and you'll see that this level has held for the last 25 years. We have not gone above it. So we can see here the ceilings that the Bank of Japan makes for the Japanese 10-year yields. You can see the ceiling that it held throughout most of the year of 2022 and then broke in 2023. Another ceiling over here at about 0.5. This is the yield curve control of the Bank of Japan, obviously. So there's another piece of yield curve control over here at about 1.08. It's going to break through, and once it does, the yen is going to fall. Why does the yen fall with yields rising, which is the opposite of most currencies? Because the yen is backed by almost all Japanese government bonds. I can show you here. The red line is the Japanese yen to dollar ratio. The higher the red line, the weaker the yen is. And you can see the higher the blue line, the weaker the Japanese bonds are because the higher the yield is. So the blue line and the red line goes together, which means the higher Japanese bond yields are, the weaker bonds are, the weaker the currency is, because the yen is the Japanese bond market. It's the other side of it. Ironically, the Bank of Japan has to keep interest rates low in order to keep its currency competitive with the dollar, but that's not going to last much longer. Why not?
That's it for today's deep dive with Rafi Farber, where he laid out his bold forecast for gold, silver, and the looming collapse of the banking system. His insights paint a sobering picture, but what do you think? Are we really on the brink of a banking meltdown, or is there still time to turn things around? We want to hear from you. Do you agree with Rafi's predictions, or do you have a different perspective? Drop your thoughts in the comments below, and let's keep the conversation going. If you found this valuable, hit that like button, share it with others who need to hear it, and make sure you're subscribed for more content like this. Until next time, stay informed, stay engaged, and as always, keep stacking.